Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. We've just released our monthly India market outlook titled Shifting Winds. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be your host for this podcast. In the previous one, we discussed our key asset class views and a macro outlook. In the current episode, we will discuss a key investor question on the impact of US Fed rate cut on Indian assets. The US Federal Reserve, or the US Fed, overlooked the buildup of inflationary pressures in the second half of 2021, deeming it to be transitory as the economy was still recovering from the economic scars of the pandemic-induced lockdowns. By early 2022, it realized that inflation had become well entrenched, forcing it to embark on the steepest pace of rate hikes to fight the runaway inflation. Between March of 2022 and July 2023, the Fed hiked rates by 11 times, pushing the policy rates by 500 basis points and held it near 23-year highs since then. To understand the impact of a potential shift in US Fed policy stance on domestic markets and how investors can position their investments, we have a special guest with us today, Mr. Vinay Joseph, who heads the investment products and strategy at Standard Chartered India. Hi Vinay, welcome to our podcast.
Hi Ravi, happy to be here.
So let's get to the most pressing question today. Market expectation of policy easing by US Fed has swung wild over the past few quarters, causing volatility in the markets. Do you think a rate cut is coming?
Well, that's a great observation and a good question to start with. Now, earlier this year, markets had begun pricing in a Fed rate cut as inflation started to moderate closer to 3% somewhere around January. However, we saw a surge in prices in the following months of Feb and March, and this pushed back expectations as the US Fed wanted to avoid a repeat of the 80s. Consequently, bond yields surged sharply post this shift. Now let's come to the current scenario. The disinflationary trends have been visible since the start of this quarter, and more recently in weakness in key indicators which the Fed tracks, industrial activity and several labor market indicators. The Federal Governor Chair, Powell, and several other policymakers in their recent communication have indicated that the Fed could start easing. And this is also reflected in swap markets pricing, with a very high probability, close to 100%, of a 25 bips rate cut in the September policy this month.
Well, thanks for that, Vinay, but could you throw us some light on how Indian assets performed during the Fed easing cycle?
Sure. While other G7 central banks have taken the lead on the easing cycle this time, a Fed rate cut could well be a turning point for investors, especially in emerging markets. So we look back at history and analyze the past rate easing cycles from 1998 to see how Indian assets have performed around these easing cycles, and we find three broad trends. First, bonds have been historically a consistent performer, generating strong positive returns around the start of the easing cycle as yields decline sharply. On an average, the 10-year IGB yield has fallen 57 bips over a 3-month ahead of the first rate cut. And this trend we see continuing over the next 6 months, where we see bond yields falling over the post the first rate cut. 2. Equities performance is more mixed, being positive in the early easing but mixed overall. Historically, Indian equities have traded weak heading into the easing cycle. On an average, the Nifty index has fallen about 10% in the 12 months preceding the first rate cut, unlike what we have witnessed recently. Performance following the first rate cut is broadly positive, likely boosted by improving foreign investor inflows amid weaker USD. But as we move a little towards the medium term over 3 to 12 months, we find that the performance starts to falter, and this is because growth challenges emerge during this period. Lastly, on the USD INR, we find it very stable. The INR has traded stable heading into the easing cycle, modestly strengthening over a 1 to 3 month into the cycle, as it is supported by a broad decline in USD index and an improvement in foreign capital inflows. Post that, it is determined on the macro scenario how it would do.
Well, Vinay, that was more of the past. But how different is the current cycle? Do you see any changes?
That's a great question also. Now, when we look at the current trend in domestic assets, it's been a marked departure from previous easing cycles, except 2007. Over the past 12 months, the Nifty index is up 28% and the 10-year IGP yield is down 35 bips, while the INR has depreciated 1% against the USD, all in significant departure of what we've seen in previous cycles. In the current cycle, we expect Indian assets to be driven by the evolution in domestic and global growth scenario, and the RBI's monetary policy response to these shifts in growth inflation dynamics. Now, coming to equities, the resilience of the domestic equities and stretch valuation premiums implies a lot of positives are discounted. Strong macro, resilient earnings, and government and policy continuity. This does raise the odds of a near-term pullback. So for us, we see an attractive risk reward for bonds, given we still see an attractive carry and given our view of lower inflation and a decline in interest rates, which could lead to potential bond gains. We believe the most prudent approach would be to have a diversified asset allocation, implying a neutral allocation to equities, bonds, gold, and cash, as this would help tide through the near-term elevated volatility given three reasons: elections in US and key Indian states, escalating geopolitical tensions, and potential growth slowdown.
Thanks, Vinay, for coming to our podcast and taking our questions. It's been quite enriching. Thank you, everyone, for listening to our podcast. If you want to get a copy of our India Market Outlook, you can please contact your relationship manager. You could also visit our SC Invest site on our portal at www.sc.com/in, and you can download a copy of our Market Outlook. Thank you as always for listening. If you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.